Good morning, everybody. It is Wednesday morning. I'm Bill with Franklin Loan Center, joining you guys again for my weekly talk. Hey, a couple weeks ago, when near the end of last year, when the new tax bill came through, I talked about getting some additional information out as it became available, and some more. So we're starting to get some more details. I just want to highlight a couple of things that do indeed appear to be, actual really affect real estate. I think there's a bunch of little things that are happening as well that may that'll be noteworthy. But kind of the big three things that I'm seeing. And by the way, I should note, I'm not an accountant, and Franklin doesn't do any accounting, so you always need to consult your accountant on this stuff. But these are just some high-level things as far as your individual effect that you'll see. Talk to your CPA. So again, diving in, the first was we kept hearing the acronym SALT, state and local taxes. They've now limited the new federal outlines, or the new federal guidelines now limit the state and local taxes to only $10,000. For those of us that live in California and have a state income tax, obviously that's going to be a pretty big deal. I mean, just your state income tax alone for anyone six figures is going to be pretty close to the 10 grand, even in the low six figures. And so that will that's going to probably get in the way of writing off any property taxes, or it most likely will. So that's kind of a bummer. The mortgage interest did see a change. It's only going to affect the absolute upper end of the market. So the mortgage interest deduction went from, it used to be interest on mortgages up to $1 million. It's now been reduced down to $750,000. For what it's worth, that was a bit of a victory, because it actually started, the initial things that we were seeing were looking like it might be $500,000. So $750,000 is a bit of a win, if you will, on that. I guess that's the art of negotiation, right? Start low and then agree to work your way up. So that's we're going to see a bit of a change on that, but that's really only homes that are really being purchased probably in the high, maybe 800-900 and above. Obviously, there's a bunch of activity in that range, but it's not everybody that's playing there. And then last but not least is the capital gains exemption. This was one that I saw that I was kind of worried about. And that was, they were talking about taking, so the way it has always been, well, it's been for years, is as long as you live in a house for 2 out of the last 5 years, you could completely avoid the capital gain for $250 for an individual, or $500 for a married couple. There was talk about changing that to 5 of the last 8 years, and it actually did indeed stay in the 2 of the last 5 years. So that's a really big deal. Other things that I think are noteworthy, there's a couple of, for example, unreimbursed employee expenses no longer available. So those of us that are W-2'd and have actual real live unreimbursed expenses, we will not be able to write those off anymore. Silly little silver lining to that. In a lot of cases, for people, when I'm qualifying someone for a mortgage, if they're writing that off, I often need to actually go ahead and reduce their income by that amount. I don't know, maybe we'll qualify a few more people. I mean, they've Fannie and Freddie have actually loosened the guidelines on that a bit. So it's not everybody that we have to reduce it. So, but anyway, those are silly little things. We'll find out more as we go. Again, I want to reiterate, I'm not an accountant. Talk to your accountant, CPA, enrolled agent, whatever it may be that prepares your taxes for specifics. And again, all this stuff is for 2018. So the return you're about to file for 2017, that's still the old rules. So anyway, it's a part of our world now. We just have to sort through it and figure out how to make it work best for us all. Again, thanks so much for tuning in with me today. Like, share, all that good stuff for me if you would. And I will see you all next week.